Hello, thank you so much for tuning in to Morning Markets. Let's get right to our top story. We are tracking Birchcliff Energy. It's the worst performing stock right now on the TSX, and it was out with a litany of announcements yesterday after the close. It cut its dividend in half. It's lowering its cash flow expectations and its production forecast in an effort to cope with lower natural gas prices. All of this was announced under the new CEO just 18 days into the job. To discuss how we got here, what happens next, we've got the new president and CEO of Birchcliff, Chris Carlsen, joining me. Chris, thank you so much for joining us this morning.
Thanks a lot for having us, Amber. Pleased to be here.
We used to speak with Jeff all the time. I asked him frequently about the dividend. I don't think it's a surprise to investors to see it cut, given where it was yielding. But as I mentioned, you're 18 days into the job. I imagine the decision was not just taken over the course of 18 days. Has this been in motion for some time?
You know what, Amber, your initial comment of commodity prices have weakened off is part and parcel of the story. And if you rewind back to 2021, 2022, and I know Jeff has said this many times as well, is that commodity prices were in great shape, and Birchcliff itself were able to pay off almost $900 million of debt, including our preferred shares. So we ended 2022 at about $130 million of debt in a really strong position. And at that time, and in that environment, we set a dividend of 80 cents a share. And we are committed to that in 2023, and we're proud of that. We paid that full dividend, $213 million, 80 cents a share, all the way through 2023. And at the end of 2023, we'll probably be plus or minus 350 of debt. And looking forward into 2024, our real concern is that commodity prices have significantly weakened off. And what we're not going to do, Amber, is take on a significant amount of debt that puts the company at risk at all. We're just not going to do that. So when we look at the forward strip price for the future and our 5-year plan, which we announced as well, there's 2 toggles that we were able to use. The first one being the capital program and the second one being the dividend. And you hit on both of them right off the bat. So why don't we start quickly with the capital program? So in November, we guided to $500 million of cash flow in 2024 and spending of $240 to $260. And for that, we would generate midpoint 78,000 BOEs a day. Well, from November to today, the gas price has significantly weakened off. And so everyone's looking at their capital programs, and internally we did as well. And we ran a whole host of scenarios of moving wells, cutting wells, reducing our capital, and our mandate at the end of all that review was to give ourselves optionality and spread out that capital spending throughout the year. So we deferred 13 wells that were supposed to be drilled in Q2 and come on in weak commodity prices in the summer of 2024. We deferred the drilling and will now drill those wells in Q3 and bring those wells on into strong prices into Q4 and potentially, depending on where LNG shapes up in Canada, but LNG on stream as well. So that was the first toggle we used, was that capital button. And it gives us a ton of optionality now where the capital is spread throughout the year. And we have another decision point in June where we can decide, okay, are we going to drill those 13 wells and commodity prices have turned, or we're making that economic decision, or maybe gas is going to zero, God forbid. But we have that optionality now. It does impact our production throughout the year by bringing those 13 wells on a little bit later, but we think it's the prudent move for 2024. And then the second lever, just because I know you're going to come back on the dividend.
Yeah, go with the second, and then I'm writing down my follow-ups.
So that second lever then is the dividend. And the dividend we set in 2022 for 2023 based on what we saw in that current environment. That environment has changed, and we're now looking at a dividend that is sustainable for the long term. It was perfect timing for us in terms of we put out our 5-year plan as well, which shows the company conservatively growing over the next 5 years to exit at 87,000 BOEs a day. And when you take the context of the environment today and the future, so that we have our priorities of returning money to shareholders, which is our goal, conservatively or methodically growing our production over the 5 years, we can do both of those things and still have excess free cash flow at the end of the 5 years in addition to that dividend. And that gives us optionality then to ride out commodity price waves and or invest further in our business.
Okay.
We have a large Elmworth asset as well. So
let me
it's about
chime in here.
sustainability.
And pick out a few things that you said. You did say, the preference in this environment is not to take on debt, but I'm looking at a lot of the analyst notes and they suggest, and it does depend on what your commodity forecast is, that even with this dividend cut and the CapEx spending plans as they are, that there still could be a bit of a shortfall. How would you fund that? Would you cut the dividend again? It sounds like there's a decision point in June. Or would you take on a little bit of debt if there is a shortfall?
Yeah, our goal is to have a strong and maintain a strong balance sheet. And we've generally used a guiding principle of 1 times year-end debt to forward years cash flow. So there's a whole host of things going on in there. But to take on a little bit of debt, we've got an $850 million credit facility. And at the end of this year, we're drawing $350 to $380, depending on the commodity prices as they finish up. But I think we're in a strong position, and that dividend, no doubt in our minds, is sustainable for 2024. And even more so is when we have a future outlook to LNG and stronger demand growth in North America in general, that dividend is sustainable for the long term.
And I know you can't make promises, obviously, because of the nature of the business, but it sounds like what you're saying, that this is not the first of many cuts to the dividend.
No. I'm saying that we will use the dividend as a tool in the future to maintain the stability of it. At 40 cents a share, we think we can pay that dividend $100 million a year for the longevity, for the long term. We're not making dividend decisions quarter by quarter.
I want to talk about the decision around hedging. I know how Jeff Tonkin felt about it. You mentioned 2022 and how you used that strong market to pay down debt. But was it a missed opportunity to lock in those higher prices? What is your view around hedging?
Yeah, our executive team's view is we saw the landscape of Birchcliff totally be changed through being unhedged through that period. And commodity prices are so volatile that we believe we want the ability to attract all the upside and have all that torque on the gas price. And the way we'll protect the downside is through that strong balance sheet, through diversifying our sales points of gas and liquids, and owning and controlling all our infrastructure so that our costs are low. So we'll protect ourselves on the downside, and we'll continue to have the torque and the upside available to us because it totally changed the landscape of the company through 21 and 22 being unhedged.
And so, yeah, the lever was always, well, we can deal with it on the cost side versus, trying to lock in certain prices. It sounds like that's still the ethos.
Yeah, that's true.
When you think about your value proposition to shareholders, the dividend yield of 7% is still a little higher than what you can get, say for a treasury. But what's the other side of that? The risk profile, the growth profile. You have had to pull back some of your growth, as you mentioned, deferring some of those projects. How do you think about your value proposition to investors?
Yeah, I think the value proposition is in the upside. I think there's a lot of excitement around LNG finally coming on in Canada, and that's going to really create a whole bunch of demand. And when you marry that with the additional export LNG in the U.S., North American gas markets are about to change in the next several years, and we're going to make sure we have all the optionality to take advantage of that. And that, I think, is how we're positioning the company with respect to we've got all the ability to protect the downside and leave all the optionality for the upside into the future.
This is getting a little bit into the weeds in terms of how Birchcliff operates, but I know that you've been very focused at Birchcliff about efficiencies, right? New well designs that maximize what you are getting with your results. Can you shed some light on that and whether you're still able to proceed on kind of those new well designs, those new projects in this new spending environment?
Oh, for sure. We have one of the best teams in the industry at Birchcliff, no doubt. And we are focused on the subsurface. We're focused on the operations above ground as well. And you're right. In this environment, we have to be focused on capital efficiencies, no doubt. So, we want to get better wells for less money. That's the end goal. And when you have high costs due to inflation over the last number of years and the commodity prices fall away, it's a very challenging environment. And you want to make sure that you're drilling some of your best locations, and continuing to improve our well designs has been a staple at Birchcliff for the long term. So when we think about our 2024 budget, our teams have picked some of the best locations in our mind that we're able to drill. So we're extremely excited about 2024 when you think about the future. And that subsurface, no doubt, our guys are all over it in terms of improving our capital efficiencies.
How do you think about your mandate as CEO? As I mentioned, only 18 days into the job. But in terms of the runway that you'll have to turn things around, has the word strategic alternatives been floated in terms of, trying to figure out ways to get some upside on the stock?
Well, you know what? So you mentioned Jeff right off the bat. Jeff is a pillar of the industry. I've worked at Birchcliff. Our executive team, the members at Birchcliff have been here for a long time. I've been on the executive team for over 10 years. We've been part and parcel. It's not like there's some new strategy coming in and I'm a new CEO from outside of the company. I think that's one of the big positives, is that we've had a bunch of promotions here who are 18 days, as you mentioned, on the job. But we've been here for a long time and been part of, with Jeff, with the executive team, building the strategy, building the culture. And that's most important to us to continue to be successful into the future versus some knee-jerk reaction or knee-jerk change. That's just not what we're going to be doing. And I would just mention one other thing is, you've noticed that it's been extremely cold over the last week or so, certainly here in Western Canada. And I'm certain it came out there in Eastern Canada as well. But we were able to continue to have operations in Alberta, in Western Canada. And this is a real shout out to all the energy workers, in Calgary, but even more specifically in the field, dealing with the cold, extreme weather so that we can all have energy and go about our day-to-day lives and be warm. I think that really gives our company, and I know the energy sector in general, a bunch of pride that we have such dedicated workers to work in that environment. It's unbelievable.